Well, good afternoon, everyone, or actually, sorry, good morning, everyone. Welcome to today's webinar. I'm Tim O'Farrell, and on behalf of our president, Wayne Matthew, and the entire Congress and Exchange Board, we're pleased to present our first session of the Construction Blueprint Series, with today's focus on an economic forecast for Baltimore's commercial construction industry. We're happy today to introduce to you three speakers. We have Andrew Bauer, who's Vice President, Regional Executive Research with the Federal Reserve Bank of Richmond. And then we have, with MacKenzie Capital, we have John Black, President, and Brendan Harman, Vice President with MacKenzie Capital. Before we begin with our speakers, I'd like to share some brief information for everyone on the Building Congress and Exchange and about the format for today. We will be having 4 poll questions throughout this session, so look for them to pop up on your screen. If you could just take a quick second and take those polls for us. We want to gauge the temperature of our membership on a few key topics. Also, you'll notice that you have a Q&A button either at the top or the side of your screen, depending on how you're using your Zoom app this morning. If you have questions for the panelists, I ask that you use that. We are going to have a presentation first by Andy, and then from John and Brendan, and then we will take a Q&A after that if we have time. Our goal is to wrap this up by about 9:50 this morning, so you can get back to operating your businesses. One of the things that we want to share with you is all of this is possible due to the partners we have here at the Building Congress and Exchange, and you'll see them as we go through on your screen. They make all of our programming possible today, and we want to thank them for their financial support of our organization. Times like this, financial support of our partners is more critical than ever. The Building Congress and Exchange of Metropolitan Baltimore is the premier organization for networking, education, and business development for the construction industry professional. It is the Building Congress and Exchange mission to help foster growth and excellence in all facets of this industry. BC's diverse membership represents the entire construction ecosystem, from GCs, CMs, and owners to subs, architects, and engineers, as well as associated professionals in finance, insurance, law, and other related industries. We're very fortunate to have the support of those solid membership and loyal partners that I've put on the screen. They help our organization thrive. For a complete list of our members, you can look at our membership directory, which is available on our website. The industry, despite being deemed essential business, is dealing with a challenging and uncertain time during this COVID-19 pandemic. As your trade association, it's our responsibility to provide as much information and resources to you to get you through this crisis and prepare you for the future. That is exactly what we hope to accomplish with our Construction Blueprint series. Today's webinar is one of several that will examine the impacts of the crisis on this industry, what your businesses can expect in the near future, and how you can plan ahead for challenges and opportunities. In addition to these webinars, we encourage you to view our COVID-19 resources page for local, state, federal information, and also look to our latest news in the Exchange newsletter, which contains current timely stories about how our members are dealing with this new norm. So let's start with today's webinar. I'm going to introduce our speakers first, and then we'll get into their presentations. Our first speaker today is Andrew Bauer, Vice President, Regional Executive Research for the Federal Reserve Bank of Richmond. Andy serves as the lead external facing officer for the Richmond Fed in Maryland, the Greater Washington metropolitan area, and West Virginia. In this role, he provides support for the bank's monetary policy responsibility and leads the execution of the bank's external management strategy. We also welcome Mr. John Black, who is President of MacKenzie Capital. With over 30 years of experience in commercial real estate finance and investment, John has executed transactions with a market value in excess of several $billion. As president of MacKenzie Capital, LLC, John oversees the firm's sourcing of debt and equity capital for local, regional, and national real estate owners, developers, and operators. And joining John from MacKenzie is Brendan Harman, Vice President, MacKenzie Capital. Brendan concentrates on sustaining and developing new sources of debt and equity capital in the marketplace and works closely with MacKenzie Capital principals to execute a variety of transactions. So we're going to start today's presentation with Andy Bauer. He's going to give us sort of the macro regional overview of what this pandemic has meant for this industry. So Andy, I'll let you start.
All right, thanks, Tim. So good morning, everybody. So I've got, want to cover a lot of ground in a short period of time to leave time for questions. So I'm going to go through things quickly, more quickly than I otherwise would. So I apologize for that. I do need to say that the views expressed here are my own and not necessarily those of the Reserve Bank of Richmond or the Federal Reserve System. That doesn't mean you shouldn't trust what I'm saying. It's just if I don't put out that disclaimer, they don't let me go out and talk to anybody. Now, it does mean that if you hear anything brilliant today, this morning, that really is positive for your business, that came from me, right? So not necessarily the bank. So moving on to the first slide, it's impossible to overstate the swiftness and the severity of the current decline. We just got the first quarter real GDP number, which declined by 5%, which is the largest decline since the fourth quarter of 2008. If you looked at the underlying detail, consumer spending fell nearly 8%, which that's a huge number. Consumption is normally very smooth and positive. That's a huge drop. Business fixed investment fell nearly 9%, and investment in structure. So that's going to be your office, manufacturing. So across the board of different types of industries, that was down nearly 10%. The second quarter is going to be a historic decline, something that we've never seen. We've been keeping quarterly GDP since 1949, and so we're expecting to see something in the order of the 30-some% decline in GDP for the second quarter. Now that's an annualized number, and so really you're looking at a 7 to maybe 9% decline in real GDP. Across the board, sectors are being hit, and the one way that I'm thinking about what's going on right now is that there's just firms are struggling across industries with a persistent shock to revenue, right? It's not just a one-time we get hit because something happened and so revenues are off for a week, a month. It's persistent because of the shutdown. And depending what the sector is, this will continue through the summer and into the fall. And so a lot of firms right now are trying to figure out, given my lower revenues coming in, what do I need to do to lower my cost for my business? And this is going to be having an impact on both obviously on labor, because that's a cost that's not fixed, but ultimately it's going to be what is going to be the impact for things like capital spending going forward. And so that's a big issue. The impact on the labor market is also historic. You've seen over the last 6 weeks, 90 million people filed for unemployment insurance just over the last 6 weeks, and we'll be getting more data on that today. And then on the recovery is likely to be somewhat on the slower side. It's just difficult to see anything like a V-shaped recovery just because of the nature of the downturn and how persistent this is. A lot of it's contingent on how consumers respond going forward and what health policies are put in place to help consumers feel more safe. Now moving on to the next slide. So one way to really capture what's going on in terms of just in a simple picture, the decline and the impact on the economy is what do we see in terms of the unemployment, the labor market. And so you have unemployment insurance claims. Historically, the previous high was 692,000. And so it's difficult to see, but there's that little red line on the right that's not part of the box delineating the chart. That's actually where the spike in unemployment claims over the last several weeks. The peak was, we had 2 weeks where it was over 6 million the end of March, and then the following week it came back down to nearly 4 million, and again, total of 30 million over 6 weeks, and that's 19% of the labor force. Tomorrow morning, we will get the jobs number and the unemployment rate for the month of April, and expect the unemployment rate to be in the high teens. So going on to the next slide. Now, if you look at, there's been a policy response to this, and there's not time to go into all of this, but I'll just say the monetary policy was swift, covered a lot of different ground, lowered rates, put in a lot of lending facilities to stabilize markets where there was disruptions, as well as to to facilitate lending to businesses, municipalities, and that's still and a lot of these programs are still being spun up as we speak. Also, regulatory guidance for financial institutions to work with borrowers and other relaxation of other requirements to help facilitate banks working with customers in order to provide make sure that credit isn't restrictive and that businesses have flexibility to do what they need to do in order to respond to this to the what they're seeing in terms of the fall off in revenue and the shock to the economy. And then fiscal policy, the CARES Act did a lot in terms of providing support for consumers, small businesses, as well as providing money for the Federal Reserve to facilitate lending to businesses, as well as municipalities. So moving on to more closer to home, I try and, spin something positive in the current outlook. And one is that we started off starting from a good place. So if you looked at job growth in Maryland, it was, or actually in the greater Baltimore region, it was, 1.5% versus the U.S. And job growth was really strong coming into this. Key sectors in our region were doing very well. Business and professional services was up 3.6% year over year. Scientific research and development, nearly 13, construction, 3.3, transportation and warehousing, 2.4. So we had a very strong labor market coming into this. There were some areas of weakness, but very importantly, the unemployment rate was the lowest that we'd had in 3 decades. And the labor force, the people coming into the labor force, it grew by 1.5%. So at least we started this from a good standpoint. Another thing is that the banking system started this very healthy, so which has allowed for businesses, which has allowed the banking system to kind of move in and provide liquidity to those businesses that have been affected by the downturn. So going on to the next slide, you can see just to show you on a map that the labor market was doing very well in our region. You can see the unemployment rate's extremely low across the greater metropolitan area for Baltimore. Unfortunately, we're going to see that rise considerably. If you get to the next slide, here we have unemployment claims for Maryland. And again, over the last 6 weeks, you've had an increase of 435,000. Again, you can see on the right that spike over the last 6 weeks. Now, it should be noted that many states are having a hard time processing all the initial claims for unemployment insurance. And so and again, because they're not set up to deal with this kind of volume. So if they were able to deal with the volume, that number would be a lot higher. So far, 435,000, that's 13% of the labor force in Maryland. And so we're expecting to see, obviously, the unemployment rate in Maryland to shoot up in the coming months. And again, going to the next slide. So just thinking about, what's been hit and kind of trying to talk about different sectors. Those sectors which were initially impacted by the health response, initially it was, as we all know, it was so restrictions on size of gatherings, and then schools were closed, and that hit certain sectors first, obviously retail trade, leisure and hospitality, hotels in particular, restaurants, transportation was hit hard, if you think airlines, and then educational services. So at some point, once you close schools and universities, send all the students home, that had an impact on all of those sectors. Now, as you move to the next slide, this is, and the next slide is just, that particular impact kind of broadened out. And so you saw not only those initial sectors impacted, but secondary sectors as well. And so it created a lot of uncertainty. Consumers became more cautious. And this is where so a lot of what I do is I spend my time talking with CEOs throughout our, Maryland, DC, West Virginia, about, what they're seeing, what their expectations are. And what I've been hearing is that the projects that are in the pipeline are currently on the board, that's been financed, they're being done, but they're seeing less new work come in. Now, in many cases, backlogs and pipelines are very strong. This is particularly true in the construction sector. Talked to a number of people in the construction sector where the pipeline is very long, and so there's still a lot of work to be done. But it is noted that there's just less new projects coming in, just because of the uncertainty that's been out there. And then I noted that consumer spending fell in the first quarter dramatically. We've got numbers in April, and so auto sales are now about 50% where they were just back from February, and that's kind of 8.5 million units is what we saw during the Great Great Recession. Now, also firms are saying that cash on hand is really important. Liquidity is key. They're really concerned about making sure they're getting paid. You hear that across sectors, and commercial real estate in particular. And then I noted that it's impacting a number of other sectors, healthcare, manufacturing, real estate. Now, there are bright spots. Construction, it is essential. So I've heard from some general contractors and others that work is off a little bit, maybe 10%, but still overall conditions are very solid. If you're essential retail or trucking or manufacturing tied to essential, things are gangbusters right now. Then IT continues to be very strong. So moving on to the next slide. So this is where I just detailed. It's just where and what particular more specific categories of workers and workers where the employment's at risk. And you can see restaurants, food service, and bars over 100,000, retail, entertainment, transportation, and accommodation. I could also include education in here. And for me, I think it's useful in this form to think about this is because all these sectors have been hit. They've got the significant shock to revenue, right? How long it persists depends on how long we're closed and how quickly consumers come back to spend. And there's the rub, because how likely are you going to go to a restaurant? What is the capacity that restaurants are going to be able to operate at? Is it 50%? Is it 25%? For a lot of restaurants, they're high fixed cost, low margin businesses, so it's difficult for them to deal with a significant shock to revenue. Same thing on the retail side. Entertainment as well, fitness centers, and how likely are people going to go back to a gym? And so all these different sectors, right, you have to think about, okay, what is the viability of different businesses going forward, given the shock to revenue? How long is that shock going to persist? And then ultimately that's going to feed into to construction of new structures. So going on to the next slide. And some of the indicators that we look at just to try and get a sense of what's going on in construction, the Architectural Billings Index, the forward-looking indicator, if it's above 50, that indicates expansion. If it's below, and so the reading for March was the lowest on record at 33.3, and it breaks it out by different sectors: residential, commercial, industrial, and institutional. And that's a 3-month moving average. And so it's not only the March number, but it's also got January and February, which were still solid. March was bad enough that you saw a notable decline across all 3 sectors. And then so you're moving on to the next slide. Other things that one could look at. So again, coming into this, metrics across different property types were very positive. So vacancy rates were good. You see completions and absorption rates were good. Rents were higher in 19 and in the first quarter than in recent years. Even retail looked pretty good. And talking to people, that there's a general sentiment that we can weather the storm. The retail, though, there is a lot of question what's going to happen on the retail side, just because there's been a shakeout in retail, as we know, over the last couple of years. This crisis is likely to just accelerate that trend that we've been seeing in recent years. A lot of people talking about office. I really don't see a permanent shift in office. There are likely some implications for how we do healthcare. Telemedicine is likely going to stay, and then education, long distance learning, likely is going to be more of a factor going forward. And then in just thinking about the implications of this for construction spending going forward, revenue shortfalls in 20 and 21, and increased debt, I think will weigh on capital spending going forward. Maryland sales tax revenue were down 31% year over year in March, could be double in April. The U.S. Treasury is set to borrow $3 billion in the second quarter. The deficit is going to hit 19% of GDP in 2020. And the overall debt to GDP for the country will exceed 100% for the first time later by the end of this year. And closer to home, Hopkins recently, Ron Daniels put out a note indicating how Hopkins has been impacted they're looking at a $100 million shortfall in fiscal year 20, a $375 million shortfall in fiscal 21. And so, and in response, they're looking at, their finances in detail, which includes a $100 million cut to capital spending through the fiscal year 21. And so again, getting back to the education, hospitals, there's going to be a lot of institutions and sectors where, because revenue's fallen off, or in some cases, they've had to, in order to get through this, they've had to take on more debt. That's going to mean lower spending in the near term going forward. And I think that is the last slide, and I was hoping to keep it within 15 minutes. Oh yeah, and then finally, the outlook going forward is really dependent on how consumers respond to the economy. Are people going to go to a mall, restaurant? Somebody actually going to go fly someplace and stay in a hotel? How likely is that going to happen going forward? Can we put in policies to provide a sense of security? Think TSA after 9/11, people were afraid to fly, so we put in a set of policies to make people less fearful. Can we do that in these different venues so that people are going to more likely to go out and spend money? And that's going to be really important in terms of determining how the economy recovers from the downturn. A big thing that everybody's worried about is that if we do this incorrectly, we open up without the proper measures put in place, that you'll see a second wave later this summer or fall, and that's something that on a lot of people's mind. And with that, I look forward to taking questions later.
Thank you, Andy. And again, your little legal disclaimer here.
Thank you. I appreciate that.
And again, if it's really good advice, you did provide it. So we're going to move on to the next segment, and we're really pleased to have John and Brendan with MacKenzie Capital to share with us thoughts on the local market specifically. So I'll kick it off to you, John and Brendan.
Yeah, thank you, Tim. It's a pleasure to be here, and Brendan and I are pleased to be part of the initial kickoff of the podcast here. So here's Brendan, my creative younger associate here, put the Black Swans Are Real kind of intro here, and we were all wondering what was going to lead to the derailment of this forever ongoing expansion and economic survival or great period here, and the Black Swan arrived in the form of COVID-19. So we're here to tell you a little bit about the financing side of commercial real estate. We'll take a much more micro view from Andy's macro view, which was obviously very sobering. And we'll talk specifically here about the various financing sources, components, the state of these capital markets. Certainly the financing world has been impacted, as we all have, with respect to all of our businesses, and Brendan will go through detail by asset class or lender source or capital source, and talk about where they are and what they're doing. Obviously, ever changing, very volatile with respect to how they're looking out. It's all about the unknown, and then we'll talk a little bit about asset classes and the various major food groups and real estate components here that where we see activity and where we see a dearth. And then we'll talk a little bit, one man's opinion, what's next. So just a little quick introduction of MacKenzie Capital and who we are and what we do. We specialize in the arrangement and placement of real estate capital for both debt and equity. We represent owners and developers in their project capitalization needs. We're affiliated with the MacKenzie companies, which gives us a diversity of expertise across from MacKenzie Contracting and Marty Copsey, construction knowledge and expertise, to the property management side from an expense operating basis, and then certainly the brokers and the market knowledge that they bring, along with our proprietary mapping data source information technology that gives us a good handle on what's going on in the real estate markets themselves. we don't have the capital. We know who has the capital. So we go out across the board, and our approach is a shotgun approach into a wide range of capital sources. We assist the owners and developers in their structuring of their project financing at the onset, early on. We've been involved in a lot of development transactions, and our approach is obviously to get as much as many capital sources interested. We know a lot of them and what their composition is and what they're looking for. So that's kind of what our job is to assist and then find the most efficient, cheapest, if you would, best terms available that meet the owners and developers' needs. So the composition of the capital, and this should have been a little more clarity. This is really all just debt capital. And as I said, this is a $3.5 trillion pie chart here representing, and we get this from the Mortgage Bankers Association, all the various components of the real estate debt market. So it's a $3.5 trillion pie, if you would. As always, the banks and S&Ls, Thrifts make up the majority, as they have. That number is lower than it has been in the past. It's been as much as 50%. A lot of that has been taken up by, and you see then in the green, the agencies and government services entities. This is your Fannie, Freddie, HUD type financing, and that's driven by a lot of this multifamily growth that we've seen recently in the last 5 to 7 years. On the left-hand side, you see the CMBS world. This has been ongoing since what I call the last great recession, late 80s, early 90s, not the most recent deep recession, but the late 80s, early 90s created the CMBS, commercial mortgage-backed securities market, which took the residential mortgage-backed security market and translated it over to the commercial side. And so this world has blew up at first and now has shrunk back a little bit, now down to 14%, and probably for those that have experienced it, a lot different than the other more traditional capital lending debt sources because of the lack of personal kind of representation internally at the lender. These are bonds that are sold in the secondary market. So Brendan will update you with respect to all of these components. The life companies, they're in that always representing about 10 to 15% of this total real estate debt capital markets. They are your conservative, long-term, fixed-rate, non-recourse type lenders. They've been very active, and as I said, they're still out there. They need to get money out, and they will continue, but their terms are changing, and they're trying to figure out pricing, and as Brendan will detail later. And the last is kind of this others, and there's been a growth in this group here. The finance companies, REITs, and others really covers, the range of what the new vernacular of bridge lenders. This is private equity, private debt capital sources. This is money that's been pooled to, take advantage of dislocations in traditional lending sources. They typically are higher rated and higher risk type lenders. They have moved into the development side. They've been doing construction loans, and as of recently, and there's a tremendous amount of competition, although this new normal here has certainly scaled back a lot of their activities and what they've been doing. So I'll turn it over, I think, to Brendan now with respect to these individual components. He can walk through kind of where they are and what's currently their parameters, and then talk a little bit about asset classes. Brendan?
Great. Thanks, John. Appreciate it. Tim, we go to the next slide. Great. Thank you. As John mentioned, banks have been the predominant provider of capital really for decades, and still is to this day. Right now in the current economic environment, banks are inundated in the PPP loans, and truthfully, it really should be where their focus is in the immediate term. they're working 6-7 days a week, 10, 12, even longer hours a day, putting out the PPP loans and also working with their existing clients on loan modifications and helping clients through this really once in a generation 100-year storm that we're going through. And while the focus is on that where it should be, it doesn't allow them to bring in new business, right? So they're focusing on their current relationships, their current portfolio, and keeping things in place where they believe they should be, versus focusing on new business, new opportunities, and new development opportunities. So I do say that with the caveat, as John mentioned, when we go out to market, it's dozens and dozens, 50 plus lenders, so to speak, that we go to depending on the project. And you get anywhere from 10, 20% of those lenders will show interest on feedback with the term sheet outlining their terms. Right now, we're seeing that dwindle to a handful, so to speak, and the ones that do want to participate are becoming very aggressive. They're seeking out the terms they want to go for, or I should say, the deals they want to pursue have very aggressive terms given where interest rates are. I see this industry, or this, I guess, asset class being still the dominant player in construction going forward. Next slide, Tim. Great. CMBS market, as John mentioned, permanent placement only, never any construction lending here. I think the risk is here when a traditional bank construction lender has a construction loan that matures, you now have less sources of capital to take it to the perm market and take it off their books. So I think you're going to see kind of a reallocation, as John showed that pie chart going forward, especially in the short and medium term. There's no liquidity in the CMBS market. They've completely shut down and not active at all. Tim, you go to the next slide. Great. Life companies, kind of steady Eddie through history here. Currently, they're hitting pause. They're pretty risk adverse, as you can imagine, being a life insurance company. And I would say that they're really waiting to see what's going to happen. They have lowered their loan to values. They've increased their spreads on their interest rates, and really waiting to see how the market responds and how their clients and loan portfolios and borrowers respond. And from a risk-adjusted return basis, life companies, given where kind of credit markets are, we're willing to pursue traditional corporate debt versus allocating money to real estate. They thought that was a better risk-adjusted return, given kind of the hiccups that happened over the past month or so. I do see this asset class normalizing. I see them getting back in the market slowly once we kind of get a better handle of where things are and where they're going to go. I will say historically, they became larger and larger players in the construction space, specifically industrial and multifamily. So a life company would come in and provide the construction loan and also provide a good chunk of the equity component for an industrial multifamily component, and it would be a one-stop shop to a borrower. It would come in, do the construction loan, it would automatically convert to a permanent loan, so you don't have a refinance risk as your developer borrower. And this was very attractive to developers specifically who were long-term holders and weren't looking to specifically merchant build and develop and then flip and make all their money on the reversion or the sale. So we're hoping this continues, specifically in the industrial space, where I think you're going to see continued demand going forward. Tim, you can go to the next slide if you like. Great, thanks. So this is the group that John mentioned, that kind of other category. Bridge lenders are backed by institutional capital. They incorporate leverage into their balance sheet so they can increase their returns. And a bridge lender is great for a client buying a vacant building or a substantially vacant building. They can leverage 80, 75% of your acquisition costs and then 100% of your renovation or good news costs for leasing. So from the construction perspective, all that TI work that you were receiving, all the renovation work on a substantially vacant building, they would provide the funds for that to happen. And from a developer's perspective, while the interest rates were higher than a bank, it was non-recourse, meaning they weren't personally liable for the money. And also they were higher leverage, so less equity kind of going forward there. Right now in the market, little hiccup, it's that they would borrow short and lend kind of long. And when you kind of have a flattening or inverted yield curve and with the uncertainty of a business plan, this model breaks down. We see that this kind of group of lenders will shrink going forward. We think the blue chip ones will survive. and it will slowly restart. But they did fill a vital role in kind of different projects, and we hope to see them continue going forward. I think in the short and intermediate term, though, we're not going to see much activity from this group at all on the bridge space, given A, their source of funds, and B, the proof of business plans going forward. Your leasing expectations are thrown out the window in this environment. No one really knows what's going to happen, and that uncertainty, that risk, it just creates people to hit a pause. So, Tim, you want to go to the next slide? Great, thank you. So I try to put a visual together here to show the different asset classes and how they're perceived in the capital markets currently. I think really no surprise that the hotel space, as Andy mentioned, is completely shut down. There's no travel. So the dominant research provider, Smith Travel Research, just put out research literally yesterday that kind of indicated that maybe this is bottoming out. We're optimistic on that, but I don't see that happening really for several months, kind of where things are. There were some short-term spikes on some disaster really, people taking hotels and also first responders and putting sick people in hotels that might have a little short-term blip. But it's going to be long-term implications on business travel, on your full-service hotels, on vacation travel, on your limited service hotels. People don't know how this is going to shake out. And when you have your occupancy that traditionally was 70-ish% down to 10%, 15%, 20%, you're not even covering your operating costs there. So they're in trouble, short, intermediate, I think medium term as well, for this to kind of shake through. And I think the jury's out on how long this is going to take to rebound, so to speak. Retail, I think the most overused term in the past couple of years was Amazon-proof retail. I think that this pandemic right here has thrown a real wrench into that, right? You know, that whole experience-based retail of gyms or Dave & Buster's, Chuck E. Cheese, those type of retail. It's just, does that business model survive going forward on high touch point type services there? I think grocery anchored retail is still doing very well. You're seeing kind of that being essential and them surviving. I think that there's a lot of over leveraged retailers as tenants in the industry. I think you're starting to see them kind of file for bankruptcy and try to rework leases. And we saw that prior to this too. So this is just going to accelerate that decline. And I think as a landlord in the retail business or focusing on construction on that, it's a real wait and see. We're seeing a lot of retail tenants pause rent and ask for deferrals kind of going forward. So short term to intermediate term, it's a big risk. Office space, Andy touched on this as well. I think this is kind of just a hold and a pause, wait and see. While certainly the I would say co-working model, I think, will be thrown upside down, where they were the dominant tenant in some markets such as New York City. They're not big tenants in our market here, so I don't see a lot of space of that kind of coming back. I know there's some rumblings on Harbor Point and et cetera on how their lease is going to happen there, but by and large, I don't see that having a large impact. I think the office market rents are still coming in. All our clients, collections are pretty much normal on the office side, and I think people are excited to come back to work. So I think that's kind of a wait and see. The multifamily residential side has been white hot for the past 5 to 7 years across the country, and Baltimore is no different. I think from an asset type, if you look at it from a macro perspective, I think it'll do very well. I think Baltimore potentially may have some oversupply issues it needs to work out. I don't think the job growth has quite kept pace with the delivery of units in our submarket of downtown Baltimore. The other submarkets, suburban markets will do well. But in situations like this, when you have uncertainty and risk, and people are willing to rent a little bit longer, willing to forego purchasing a home where they're locking into long-term financing personally. So I think on the short intermediate basis, I think you're going to see apartments do well and survive. Industrial, I think is one thing from this whole pandemic has shown that this whole decades of just-in-time inventory model has really been thrown for a loop. You're seeing companies try to talk more about their supply chain and bringing more of that supply chain back home. The inventory that companies used to pride themselves of driving their inventory down, you're seeing them now kind of brag, hey, we do have extra inventory. Altria's CEO was diagnosed with COVID a month ago, and he was very proud to say, although we're shutting down production for several weeks, we have 2 months of inventory in our warehouse there. So they're able to survive that intermediate short-term shutdown. And I think it depends on the goods that you produce, right? Obviously with food, specifically meat and poultry, you can't do that, right? So what's going to happen there? But I think you're going to see a growth of industrial space. This is only accelerated. I think the e-commerce boom that we've experienced here, I think you're going to see last mile distribution centers grow. You're going to see, I think, the U.S. government become more and more of a tenant. I've heard rumblings of 100 million square feet across the country. Who knows what that number is and how quickly they can implement it. But I think you're going to see them take space. And also in a sub-market kind of that is refrigerated warehouses. I think this is really accelerated the Instacart kind of model. I know Kroger, which locally has the Harris Teeter flag, is bought a company in England called Ocado. I'm probably pronouncing that wrong, but I think you're going to see more and more of the grocers kind of move into the industrial space where they were doing a lot of their inventory at other stores. Once you hit a critical mass, they can then move that to centralized warehouses and kind of do deliveries. So, Tim, we go to the next slide here. Great, thanks. So John and I are going to tag team this as we kind of come to the end here. I'll start out by saying I think there's still the right capital if it's the right project. Lenders are busy. They don't have time to kind of stretch and push to all the projects they need to go to. But in the short, medium term, it's a real kind of wait and see pause. But I think the risk of asset classes will be reevaluated going forward. And next slide, Tim. John, I'm going to close it out.
Yeah, and just real quick on one thing that needs to be emphasized here. This is an historic low interest rate environment. So when we are seeing lenders that are looking to get money out the door that still want to make loans, the rates are in my world stupid cheap. I mean, we're talking 3%, even less sometimes on 10-year fixed rate money. So, and that's obviously for kind of best in class, low leverage transactions. But, the fact is that there's still money out there, as Brendan says. It's for the right deals. It probably is more selective. There are some lenders that are flooring their rates and deciding where this is all going to end up. And the one thing we didn't talk about as much, which is the equity side, we're seeing still interest from family office, high net worth individuals, and some funds, which is where we focus our equity participations. They are longer term kind of perspectives and hold analysis for the most part, especially the family office and high net worth individuals. They're looking for, value creation, value add type opportunities or ground up development on a lesser basis. So the question then is, where should the focus be? The focus is, and we always emphasize, it's about sponsorship. The ability and the acumen and the integrity of the partner here to deliver, to have the right project is key. We're obviously looking at the various industries that will benefit and from the shift in behavior, as we call it, or the new normal. Obviously, healthcare and we're working on a biotech building right now that's a drug manufacturing facility, clean rooms, etc. We're looking obviously on the industrial front. The renovation side of the equation, the value add component to it. So that's kind of where we're looking at opportunities for this new world. And listen, there's a ton of money being raised right now as we speak, trying to look forward at the distressed world that may result as far as these CMBS loans, which are going bad and don't have the friendly banker or friendly life company representative here that can kick the can down the road and defer payments or something. So there is this, massing of capital then on the distress side, and they'll look to buy right and then create value through renovations, management, upgrades, etc. And then lastly, there's Brendan and I debate the suburban versus urban focus. The maybe, it's been all about the live, work, play downtown kind of thing. Does this virus, does this density, aversion now play into a spread back to the counties, back to the suburbs, so to speak, the new suburban urban, I guess. So thanks you all. That's really it for us. I'm so hope we didn't go over right about at our 9:50 cutoff, Tim. So we'll take some questions.
John, Brendan, Andy, thank you for your time. We do want to get into a couple questions here. And the first thing I want to start off with is, the customer for most of our members falls into the categories of, higher education, lower education, private sector, healthcare, and then there's some government business as well that feeds their pipeline. So my question for all of you is, how do the pressures on state and local budgets impact this pipeline, especially without additional aid to the states from maybe the federal government? Anybody want to take that one?
Yeah, I guess, because I mentioned in my presentation. So Baltimore City put out some numbers about, I think they're losing $20 million a month. I think they said, because costs are up, and they're looking at where to cut, try and fill the gaps. And then they mentioned a number for next year. Like school construction they're still planning on going forward with that, but some other capital outlays they're cutting back. And so it just seems to be the case this is across the board, just to bridge from where we are now to the end. There's just going to be debt levels, corporate, state, federal, personal are going to increase. And so that means, debt service across the board is going to be higher for the entire economy. So that means there's just going to be less savings available to be channeled into investment going forward. Still, there's a lot of positive, projects that need to get done. It's, we're an economy that requires people to continually innovate. There's new forms of how we distribute goods. There's new ways of how we, provide services. And so you're still going to have construction. You're still going to have investment, but it's just not going to be at the pace that we would have had, if not for this event.
Great.
We have another question. Productivity on project work sites are at a low because of the PPE and social distancing requirements that are in place. And it's hard to quantify what that loss is. Will the investors and developers take advantage of these low interest rates and aggressive construction costs to hopefully keep sort of not even a planned stimulation to the construction industry?
Let me take a shot. I do see, because of the new guidelines with respect to safety and on the job, and we see construction timeframes being extended. We hear that construction rates or costs may come down in the future here. So it's an unknown, I think, with respect to the, what's the impact. We're certainly still out there. We have development, repositioning opportunities in the works right now. Everyone is trying to get their arms around, costs and supplies, and, as we all kind of navigate our way through the next side of this thing, we'll have to see how that goes. Brendan, you have anything?
I think, to point out the question, I think the interest rates are really low. I think from a developer's perspective, they want to obviously capitalize on low cost of capital, but it's what's the uncertainty on the back end? How long is this going to take, and how long is your construction project? How long is your development going to take to deliver? I think is the major question. And are you betting that the economy is going to be at the right spot when you deliver? So as John mentioned, we are still seeing development opportunities that we're working on, and they're not necessarily trying to time the market. I don't think anybody wins doing that. I think they're optimistic that the market will turn when they deliver in 2 years.
Yeah,
So and then
yeah.
it's just
We're
it's just
even
then
working on a new hotel development. So,
Yeah.
Where's the hotel world look like a year and a half from now? So we're trying to get that one closed and wrapped up. And certainly we've got nervous lenders on the project. So the construction timeframe may be extended a little bit, but the historic low interest rate should help with respect to the interest carry to get you through the other side.
Yeah, the only thing I would kind of add on to what John said, just the uncertainty is a factor. And so, the people that we've talked to in the construction, things are solid now. They're always concerned about, well, what if there's another, shutdown change by some local county or state, regarding to, whether or not you can do construction or not. That should be alleviated as we open up the economy. But just a lot of concern about what happens the rest of the year, should there be another outbreak. And so for a lot of people, it's just, it's difficult to really do new plans going forward, given that right now there's just an elevated level of uncertainty.
Well, that's a good term, uncertainty. So we're going to wrap this up with one last question for our panelists. And what should our members in our industry community look for as indicators that are going to tell them to have faith that we're back on a positive trajectory in the economy? Is there one thing or a series of things that we should look to that say certainty or some predictability can return and normalcy can return to the market?
So, I would start off. So for us, the fiscal policy's done a lot, the monetary policy's done a lot, and it really comes down to health policy and how we're able to open up the economy and allow commerce to engage, help alleviate this revenue shock and perhaps, get, people back to business. And so a lot of that is we're looking at the same thing the health officials are looking at. So we're constantly talking to hospitals, researchers. What do hospitalization rates look like? What does the infection rate look like? And if we keep those manageable, right, and open up in a safe way that allows the economy to get going again, we'll have a stronger second half of the year. If we do it wrong, and then spreads start to increase, hospitalization rates start to increase, ICU, utilization increases, then we start to backtrack. And so for me, if we got to keep the economy going, and that really means getting the health piece right.
I think there's two answers. I'll give my 2 cents here. Short term, I think it's all about kind of as Andy alluded to, the data, the statistics, the deaths, the ICUs. I read a quote this morning. This pandemic, this downturn, this economic calamity was brought to us by a health issue, and the only thing that's going to get us out is a health issue. Meaning, I think a vaccine needs to be developed sooner rather than later. If that happens, we'll get a much quicker return to the new normal, I guess. So that's the hope. Is obviously, and we're surrounded with some great medical institutions in Hopkins and University of Maryland, and let's all keep our fingers crossed with respect to the development of the vaccine drugs that'll help pull us out of this thing.
All right. Andy, John, Brendan, really do appreciate your time spending it with our membership today. For our members, I want them to be aware that these slides and the entire webinar are going to be available on the Building Congress Exchange website under the COVID-19 COVID-19 section. So you will be able to access, again, the slides and this entire webinar. We do have some additional webinars in the works being planned. We have the future of design, look at how coronavirus-related issues will alter design decisions in building systems, as well as adjusting current and new projects, and business development and marketing. We look to, which we do already have set from Tuesday, May 19th. So look for those dates on those additional webinars. It's our goal, it's our mission for you to have the resources and information available to you so that you can navigate this for your businesses. And as an industry, we come out stronger, ready to really thrive as things return to whatever the new normal is. On behalf of the Building Congress Exchange Board of Directors, I want to thank Andy, John, and Brendan for your time this morning. And I want to thank our members for your attention to this issue. We're here for you. It's our organization remains vigilant on providing you the resources and connections so that you can thrive and succeed, whether we're in a pandemic or not. So again, thank you all for your time this morning and have a great day.
Thank you, Tim.
Thank you
Great,
all.
thanks.